Welcome to another episode of Tutorials with Ike. Today, we're going to look at another topic under business finance called financial statement analysis. If you're new to this channel, don't forget to hit the like button, subscribe, comment, and share. And make sure you share with all your friends as well. And let's get right into today's topic. So, this topic is called financial statement analysis, like I said, and it's basically about evaluating a company's financial reports to see if the company is actually doing well. For example, if you want to buy shares in a company or you just generally want to know if a company is doing well, this is what you use, the financial statement analysis. So you just use to evaluate or analyze or see the performance of the company or the health, or to see if the company is actually doing well for itself, or the company is just wasting resources or anything. So if you want to work at any company, or you just want to use the information of the company for something, or you just want to recommend it to someone, you want to work there, you want to buy shares in the company, you want to see if it's a good idea that you invest your money there or it's not a good idea, you use this topic. So that's basically all what the topic is about. And on this topic, there are lots of things you actually have to look at, and I'd like us to pay attention so that we understand everything. And if you don't really understand the terms in it, you're actually going to get a bit confused, because this topic is more about understanding than memorizing. So you just need to understand. Now, the first thing you are going to look at is sales. And the sales is under the trading profit and loss account. So the trading profit and loss account just tells you how much profit the company is making. You get it? How much profit, the loss, and everything is making. And under it, the first thing you're going to look at is the sales. So the sales is, everyone knows sales. If you go to a company and they're like, today they made sales of 200 cedis, it means everything they've sold or their total revenue is 200. So if I'm selling, let's say, 10 sachets of water, or I'm selling 10 bottles of water, and one water is, 1 cedi, one bottle of water is 1 cedi, it means my total sales is going to be 10 cedis, because 1 times 10. So the sales is the total amount you are making. But then when your sales is very high, you shouldn't be too excited, because it doesn't really mean anything. Because for here like this, the sales here is 200 cedis. So it means for this particular company, their sales, this can be like a day, a month, or a year. So let's assume maybe it is a month. So it means in a month, their sales was 200 cedis, meaning what they sold amounted to 200 cedis. But then you can't really use this to do anything, because it could be that maybe half of the money is the cost they use for, producing it, half was for rent, half was for transportation. They are going to pay tax, they are going to pay their interest, maybe if they've taken a loan. So the sales doesn't really do anything. So after the sales, the next thing you're going to look at is the less cost of sales. Less cost of sales. Now, if let's say you're producing something like a marker, and your sales was 200 cedis, let's say, so let's assume that this I'm just producing just one marker, and this marker is 200 cedis, so they just bought one, so that's 200 cedis. Now, the less cost of sales is how much the cost you incurred on producing this marker alone. The cost incurred on producing this marker alone. So as you can see, there are some writings. So maybe the printing company that I paid to print this, the design on the cover and everything. And mind you, the less cost of sales is actually the cost only on what has been used to produce it. So if there are other expenses such as transportation, or maybe rent, assuming maybe where I work at, we rent the place, you don't add it to the less cost of sales. The less cost of sales are the direct cost of the product, or the cost incurred in producing the product. You get it? So if you are making maybe anything, if it's cocoa, if you are producing cocoa, like the direct cost of you producing the cocoa, not other expenses. Other expenses are not involved. Now, when you subtract the less cost of sales from the sales, or the cost that you incurred when you are producing that product from the sales, you get what you call the gross profits. So here the sales was 200 cedis, and the cost incurred on the sales was 120, meaning we use 120 cedis to produce, let's say, the marker, assuming it's the marker you're talking about. So it means what you are left is the gross profit, which is 80 cedis. Meaning when you take out the costs you use to produce the marker, you're left with 80 cedis. Now remember, to that 80 cedis, that's not your profit yet. Because that 80 cedis, like I said, you might pay for rent, you might pay for other things, maybe some emergencies came along and everything. So you still have to subtract all those things. So those other expenses that come in it are called the less expenses. So the less expenses are external expenses, maybe transportation, any other thing, maybe rent, if you are renting the place, or any other cost. So they are called the less expenses. So other expenses apart from the cost directly incurred on producing the product are called the less expenses. Now, when you subtract the less expenses from the gross profits, you are going to get what you call the profits before interest and tax. Now, in economics, you know that profit is total revenue minus total cost. Total revenue minus total cost. And our total revenue was 200. How much we made? And now these two costs are the main costs we've incurred. The two costs here, the less cost of sales was the cost we incurred on producing the products. The cost we incurred on producing the products. And now we've also subtracted the cost, the other external costs. So it means right now we've subtracted all our costs. So it means right now the less expenses, which is 30 cedis. Now that we've subtracted it from the 80, we are left with 50. So it means this 50 here is our profits. Right now it's profit for us. But mind you, remember you are in a company or you are operating in a company. So you are going to pay interest. If you've taken a loan, you have to pay. You're also going to pay tax. Any company you are operating, you are going to pay tax. So even though it is your profit, you have not paid the interest and the tax. So we say it is the profit before interest and tax. That's it. So if you subtract the less expenses, don't be so happy because at the end of the day, you are going to pay tax. And sometimes your tax can actually be very high. So this is called the profit before interest and tax. The profit you are making when you have not paid the interest and the tax. So that's about it. Now, the next one is the less interest. So now that you've got the profit when you have not paid the interest and the tax, obviously you want to know how much the company has. So you are going to see the less interest. And the less interest is the interest you're supposed to pay to the bank if you've taken a loan. So let's assume I was about to start a business or maybe a manufacturing company. I took this amount of money. So this one, it is, let's say 10 cedis. I'll have to pay 10 cedis to the bank because I am owing them. So the less interest is the interest I'm supposed to pay to the bank or to pay to anyone I am owing. And you can't say that you are going to start spending the money when you've not finished paying the interest to whoever you are owing. So we are going to subtract the less interest from the profit before interest and tax. And straight away, you realize that here was profit before interest and tax. So when you subtract the interest, the less interest is the same as interest. When you subtract the interest from the profit before interest and tax, now you've taken away the interest. So it's now profit before tax. The interest is here, you've taken it away, so it's now profit before tax. And the profit before tax is the profit you are making when you have not paid tax. The profit before tax is the profit you are making when you have not paid tax. And you can't also say this is your money because at the end of the day, you've registered a company, so you need to pay tax mandatorily. So the tax here is referred to as the less tax, which is 15. So which is tax? So if your tax is 15 cedi, you're going to subtract the 15 from the profit before tax. This was profit before tax, and now you've paid the tax. You are going to subtract the 15 from it, and now you are going to get the profit after tax. And the profit after tax is the final profit you are going to make. So if you want to really know how much the company is actually making, you have to use the profit after tax. That is the final profit you make. I hope you guys get it. Let me go over again shortly. So we said at the beginning you made the sales. Let's assume this is the marker I was producing. Everything plus the cost, interest, tax, and everything. I amounted to 200 cedis. One is 200 cedis. Someone has bought it. Now we said that we use an amount of money to produce this marker. So let's assume that we use 120 cedis to produce this marker. We call it the less cost of sales. So that one is 120. Now, when we subtract how much I used to produce this marker or the cost of producing this marker from the sales or from how much the person bought it, we get the gross profit. But remember the gross profit too, it has other things are in it, maybe the rent, other external transportation and everything. So when you subtract those expenses from the gross profit, you get the profit before interest and tax. We call it profit before interest and tax because at this point you are making profits. But then remember you are a business, you are a company, and you have to pay tax to the government. You also have to pay interest if you've taken loan. So it is the profit before you have paid the interest and the tax. After the profit before interest and tax, you are going to subtract the interest that you are supposed to pay to the bank. If you are owing someone and the person said you should pay back, you are going to subtract that less interest. And now you get the profit before tax. Now you've taken away the interest, you are getting the profit before tax. Now, after you get the profit before tax, obviously you want to know how much you're actually getting when there is no tax involved. So the tax here was 15, and we subtracted the 15 from the profit before tax. And when you subtract the 15 from the profit before tax, automatically it becomes profit after tax, which is now 25. So now what the company is actually making, or if it was this marker, what I'm actually making, or my share is actually 25. How much I've got at the end of the day. I hope you guys understand it. So yes, that's for the trading profit and loss account. Now we are going to go to the balance sheet. So the balance sheet is basically how much the company has, like how much the company is worth, basically. And the first one you are going to look at is the fixed assets. Fixed assets. Now, fixed assets are the long-term assets in a company. Long-term, as in the assets that are going to be there for a very long time, like buildings, machines, and those things. Those things, they are going to be there for a very long time. So you are seeing the worth of the assets is thousands this year. So maybe if you add the building, I mean, it's not really possible for a building to be 1,000 cedis, but then this is just a sample. So if you add the building, the machinery, and everything in the company, it's going to amount to 1,000 cedis. Those things are fixed. Those things are fixed. Now we move on to the current assets. And the current assets are the things that you have in the company, or the assets that you have, or the valuables that you have in the company. But then they are not long term. They are not long term, so they are just short term. After some time, they are not going to be there again. So the first one under the current assets we have is inventory. Inventory. Inventory means the things that are in the company that are yet to be sold. So if I'm selling an iPhone, if you come to my company or my shop, the iPhones you see there are the inventory. They are not really physical cash because at the end of the day, they are not sold yet. But those things are part of my assets because the moment I sell them, it transforms into money. So the things that are yet to be sold in a company are called inventory. Now we move on to the debtors. So debtors are the people who have taken something on credit in your company, or the people who are owing you in the company. So if, let's say, in your company, people are owing you, let's say, 35 cedis, 35 cedis, it means it's part of your word because at the end of the day, the moment they pay you, I mean, it transforms into money. So the people that are owing you are called the debtors, or the money that people are owing you are called the debtors. Now, the last one is the cash. And cash is very self-explanatory, how much you have, like the physical cash. And that one has to be physical cash. It doesn't have to be a product or maybe a machine or a building. No, that one is physical cash. And that one here is 15. Now let's go to it. So now we go to the total. So the total, when you add the fixed assets, we said the fixed asset was 1,000 cedis and the current asset 50 plus 35 plus 15. You are getting 95. So the total asset is 1,095. We are just using the example here. 1,095. It could be any, I mean, it could be any value, but then we are using the example here. So we can say the total asset is 1,095. Now we go to capital and liabilities. So capital is how much you invest into a company when you are starting it. And the liabilities are how much you owe or the things you have to pay for. That's basically it. And equity is your shareholders' wealth. So the shares you have in the company, how much they are worth, we call that the equity. And the one here is 750. And like I said, this is just an example. So equity, 750, how much the shareholders have in your company. That's 750. The net profit. The net profit is the profits you have after incurring all the expenses or after paying off all the expenses. So the net profit is 25. Where is it? 100. The net profit is 25. And you realize that the net profit is the same as the profit after tax. So net profit is always the same as profit after tax, meaning the final profit you are making. And that one, like I said, is 25. So when you add the equity and the net profit, you are getting 775. The equity and the net profit, you are getting 775. Now we move on to the long-term loan. The long-term loan are the loans that you've not paid yet, but then they are long-term. So maybe you are supposed to pay them over 5 years, over 10 years, over 2 years, over 3 years. And that one here, we say it is 270. And we move on to current liabilities. So current liabilities is like the opposite of the long-term loan. There are things you are owing, but then you pay them in a very short time. So maybe just few things. Maybe, oh, you're owing someone right now. You don't intend to pay them over a long time. Just maybe some few days or just few months. We call them the current liabilities. So the current things that you're supposed to pay in a very short time. And the last one is the capital employed. So the capital employed is how much you're using to run the daily affairs of the company. So the capital, every amount of money you have invested to ensure the smooth running of the company, that one is 1,095. So yes, that's basically about it. Yeah, so these are the things you need to know when it comes to financial statement analysis. If you understand all the things here, it won't be difficult for you at all. It's just a matter of understanding them, what each of them mean, how to calculate them. So you just have to know that maybe gross profit is the sales minus the lost cost of sales. I mean, all those things. Now, when it comes to financial statement analysis, the information you see here is actually used to assess 5 main things or 5 ratios. And the first one is profitability ratio. And just by the name, you can tell So the profitability ratio is used to assess the profit making of the firm. If you want to see if the company is doing well in terms of profits, you use the profitability ratio. And the first type of profitability ratio is the gross profit margin. So the gross profit margin is used to determine how well the company is doing or how much revenue the company is making after subtracting the less cost of sales. And I said the less cost of sales are the costs that were incurred on producing the products. So if you want to see how much profit or how much revenue the company is making, after you subtract the costs of producing that product, we use the gross profit margin. And the formula for the gross profit margin is the gross profits over the sales, or you can also say the turnover, times 100%. And guys, please take notes of the formulas. You have to choose them so that you understand it very well. So the gross profit margin, the formula is the gross profit over the sales or the turnover times 100%. Now, we are going to use the values here. So what is the gross profit? The gross profit is 80. So the gross profit can also mean JMP, just for short. So the gross profit is 80. So right here, we have 80. We are just going to substitute the values. And what was the sales? Sales is 200. Then you have times 100%. So at the end of the day, you have 80 over 200 times 100%. So let's see what you get. 80 over 200 times 100%. So you have 40. So it means at the end of the day, you're going to get 40%. Make sure you always add a percentage. If the formula has percentage, make sure you always add it. So this 40% means that what the company is making, 40% of their revenue is the money they get after they subtract the less cost of sales, or after they subtract the cost incurred on producing the commodity or the product. So it means 40% of 200 is what you are getting as profits when you don't add the costs incurred in producing the product. That's all about the gross profit margin. So I'm going to move on to the net profit margin. So unlike the gross profit margin, the net profit margin is actually the percentage or the revenue you are getting after you subtract all the expenses from it. And the formula for the net profit margin is the net profits over the sales or the revenue or the turnover as well, times 100. Yes. So for this formula, it's used to find if you want to see how much profit you are making when you subtract all the costs, the tax, the interest, the cost incurred when you're producing the product and everything. This is the formula you use. And the net profit, you have it here to be 25, which is the same as the profit after tax. So you have 25 over the sales. The sales here is 200. Then times 100. It's supposed to be 100%. So times 100%. And let's do it on the calculator and see what you get. So you have 25 over 200 times 100%. We are getting 12.5%. So we get 12.5%, meaning that 12.5% of your sales, which is 200, is what you are getting as a profit when you subtract all the expenses. So if you want to know how much profit you're actually making, you just do the net profit over the sales times 100. And the value you get is in percentage, which is the percentage of the sales, which is profit minus the expenses. So if your net profit margin is high, or if it is very high, it means the company is doing very well. It means that a higher percentage of your revenue is actually profits when you subtract the expenses. And for the gross profit margin too, if it's high, it means you're using your resources a lot, or you're using your resources very well. So if it's low too, it means that you're actually not getting a lot of profit. Your sales might be high, but when you subtract all the expenses, a lot is just the cost. So it means the company is actually not doing well. So the higher the net profit margin, the more successful the business, and vice versa. The next thing I'm going to look at is return on capital employed. Return on capital employed. And you use this formula if you want to see how well the company is using its capital. So if you invest into a company or you start a company and you put in an amount or any capital, you want to see if you are using the capital very well, you use this formula. And you want to see how much of the capital is generated as profit. Because if you are putting in the capital, you're expecting profit. So you want to see how much of the capital is generated as profit. And the formula for that one is the profit before interest and tax over the capital employed times 100. Unfortunately, it will not go there. So you can just do it for the profits before interest and tax. You can do a PBIT. It's also the same as you guys can see, a PBIT. So you can do PBIT over capital employed times 100. So the PBIT is the profit before interest and tax, which is the profit you make after all the expenses have been subtracted, but then you've not yet paid the interest and the tax. So it's before the interest and tax over the capital employed, which is right here, times 100. And what is the PBIT? The PBIT here is 50. So you are going to substitute the values. So we have 50. Then the capital employed here, which is the last one here, is 1095 times 100%. And let's do it on the calculator and see what we get. So 50 over 1095 times 100%. So we get 4 points. So we can just do it 4.6. So one decimal, please. So 4.6%. So our return on capital employed is 4.6%, meaning every time you invest, if you invest, let's say 1,000 cedis or 100 cedis, anytime you invest, 4.6% of the capital is generated as profits. 4.6% of the capital is generated as profit. So use this formula if you want to see if the company is actually using its capital very well. So in case you want to invest in it, you see if the company is actually doing well or is just wasting the capital. So if the ROCE, the return on capital employed, is also called ROCE. So let me just write it here. Let me write it somewhere here in brackets. ROCE. Yes, so if you see it, sometimes you can only see the ROC, which is the return on capital employed. So if the return on capital employed is very high, it means the company is actually using its resources very well, or it's using its capital very well. But if it's low, it means the company is not using its capital very well. So there's no need to invest into the company. That's what this formula is about. Now let's move on to the next one. Now we move on to the interest cover. And the interest cover is how well the company can pay its interest. I mean, if you are starting any company, you are going to take a loan. And the loan, you're also supposed to pay interest. So it's saying this formula is just telling you how well the company can pay its interest, if it's actually eligible to pay its interest, or it will not be able to pay its interest. And the formula for the interest cover is the profit before interest and tax, which is PBIT. PBIT, which is right here, over the interests. Yeah, so the PBIT over the interest. So this is the formula for the interest cover. And what do we have as the PBIT? We have 50. And what do we have as interest? And our interest is 10. So 50 over 10. So we have 5 times. And this one is measured in times. So the units is supposed to be times. So 5 times. So it means our interest cover is 5 times. And what this means is that the interest that you are supposed to pay to the bank or anything, you can actually pay it 5 times. So if, let's say, you are supposed to pay 5 cedis to the bank, it means you actually have 25 cedis on you. So you can pay it 5 times. That's 5 times 5. You get it? So if it's actually once, it means you can just pay it once. If it's 1 times, assuming we got, let's say, something like maybe 1 over 1 or 2 over 2 or 3 over 3, it means you can just pay it once. If it is below 1, if it's less than 0 point something, it means you are not able to pay it. That's what it means. So the higher the interest cover, the more successful the business is. The lower, the less successful the business is. That's it. Now we move on to the next one. Now we move on to return on assets. Return on assets. And anytime you see return, it means how much you are getting. So how much you are getting from the assets. So, I mean, if you're having any company, there are assets that are going to be there, whether fixed or current. So maybe buildings, machines, everything. So you want to see the value you are getting from these assets. So there's the formula you use. And the formula you use is the profit after tax. So profit after tax, which is also called PAT. So if you see PAT in it, it means profit after tax, then over the total assets. And the total asset is 1,095. When you add the fixed asset and the current asset, you get 1,095 times 100%. Now, what is PAT, which is the profit after tax? So that's the final profit. So this one, you've subtracted all the expenses, and we have 25. So 25 over 1,095 times 100%. So let's do it on the calculator and see what you are getting. So we have 25 over 1,095 times 100%. And we are getting 2.283. So we can just say 2.3. So 2.3%. So our return on asset is 2.3%. What this means is that when you add the asset, the value of the asset, 2.3% of the asset is what you are getting as profit. 2.3 of the asset is what you are getting as profit. So you use this formula if you want to see if the assets are being used well, if you want to see how effective or how they are utilizing the assets, you use this formula. So if it is very high, it means you are using the assets very well. But if it is low, it means there's not much effective usage on the asset. So that's about the return on assets. Now we move on to return on equity. Return on equity. And like I said, when you see return, it's just what you are getting. So it's just what you are getting from equity. And like I said in the beginning, equity is the shareholders' wealth. So it's what you are getting from the shareholders' wealth. So when people buy shares in your company, what are they getting? So this formula is what shareholders use to determine if your company is good enough for them to invest. If they want to invest in your company, this is the formula they use. And the formula for this is profit after tax over equity times 100%. So profits, or you can just say PAT, profit after tax over equity times 100%. Now, what is profit after tax? Profit after tax is here, which is 25. So we have 25 over, then equity. Equity is right here, which is 750. So 70, which is the shareholders, then times 100%. Now let's do it on the calculator and see what we get. So you have 25 over 750 times 100%. So you are getting 3.33. So 3.33%. So what this means is that 3.33% of the shares in the company are what you are getting as profits. So 3.33% of the shares is what you are getting as profit. So if you are going to invest into any business and they tell you maybe their return on equity is, let's say, 10%, 20%, 1%, it means that's the amount or that's the percentage of the shares that is transformed into profit. Yeah, so that's basically it about return on equity. Now we are done with profitability ratio, and I'm going to move on to liquidity ratio. And liquidity ratio is used to determine how well the company can pay its liabilities using its liquid assets. And the first one I'm going to look at is current ratio. So current ratio. Yes. And for this one, it's used to see how well the company can pay its liabilities. But then this one adds everything. So whether it's cash, if you have maybe some treasury bills, like anything you have, it adds inventories, like every single thing. And the formula for the current ratio is current assets over current liabilities. So the formula for the current ratio is the current assets over current liabilities. So if a company wants to see if they can pay their loans or if they can pay their liabilities, they use this formula, and this formula adds everything. So even the things that are in the shop, if it's iPhones, they add how much the iPhone is, like everything. So let's say they are supposed to pay maybe 10,000. They are supposed to pay 10,000 or 5,000. That's the liability they have to pay. It adds everything. if this iPhone is 1,000 cedis, they add everything, the cash in the company, the treasury bills, the debtors. If people are owing them, they add everything. Then they used to see if they can pay for their liabilities. Now, what is the value for the current assets? So where's current assets? Current assets. Current assets. So the total is 95. As you guys can see, 50 plus 35 plus 15. So current assets is 95. Then over the current liabilities. The current liabilities is here. They've given us the value, which is 50. So now we do 95 over 50. And we get 1.9. 1.9. And this one to the unit is times. So what this means is that the liability that they owe, or what the company owes right now, they can pay it 1.9 times. 1.9 times. Assuming we sought for this and we got, let's say, 2 times, it would have mean they can pay it twice. So if, let's say, what they are owing is 1,000 cedis, it means right now they have 2,000 cedis. So they can pay it once and they'll be left with 1,000 cedis again, and they can pay it again. So this is 1.9 times. So it means they can pay it almost twice. So it means they have more than enough. That's basically it for the current ratio. Now let's move on to the next one. Okay, so the next one I'm going to look at is the quick ratio, which is also called the asset test ratio. So unlike the first one, for the first one, it adds everything, the inventories in the company. So if it's, let's say, an iPhone shop and they want to see how well they can pay their liabilities or their loads, they will add the value of the iPhone, everything, so that when someone comes and buy, they can use that money to pay. So for this one, it doesn't add inventories, meaning that if there are things that have not yet been bought or are yet to be bought, they don't add this. So they'll see the actual stability of the company. And the formula for this is the current assets minus the inventories over the current liability. So unlike the first one where that one it was current assets over current liability, this one they don't want to add the value of things that have not been bought yet, so that in case maybe something happens to them or people don't buy it, they'll still be able to pay. So it subtracts the inventories. The inventories are things that are yet to be bought. So the values of the things that are yet to be bought, but then they've not yet been paid monetarily. And what is the current asset? The current asset is 95, 50 plus 35 plus 50, which is 95. And what is inventories? Well, inventories is 50. So the value for inventories is 50, as you guys can see here. Then over the current liability, and the current liability is 50. So now let's do it on the calculator and see what we get. We have 95 minus 50 over 50. And we get 0.9 times. So for the first one, you see, it was actually able to pay to the extent that it could pay almost twice when inventories were part. But this time, they've taken away the inventories, meaning that things that have not yet been bought, the value of the things that have not yet been bought, and now it can pay up to once, which is 0.9 times. So it means it actually cannot pay all its liabilities when you take away the inventories. Do you get it? So it means the company is not too stable enough, because as a good company, it's supposed to be able to pay at least all its liabilities without the inventories, because anything could happen to the inventories. Do you get it? So yes, that's it for the quick ratio. So it's used to see how well the company can pay for its liabilities when you subtract the inventories from the current assets. That's it for the quick ratio. Now let's move on to the next one. Now we move on to the cash ratio. So the cash ratio is used to determine how well the company can pay its liabilities using the cash it has. So unlike the first one where we were talking about the assets, so it accounts for all the assets it has, maybe the buildings, like any other thing. This one talks about only the cash, or things that can be converted to cash in like a second, or like anything that can be converted to cash very quickly. And the formula for the cash ratio is cash plus the marketable security over current liabilities. So this is the formula for the cash ratio. So if a company wants to see how well they can pay their loans or their debts or their liabilities, using the cash it has. This is the formula they are going to use. So this one, it doesn't talk about the assets. So the valuables the company has, it doesn't talk about it at all. This one is just about cash. And for the cash, it's given to us as 15. So let's substitute the values. So cash is 15. Then marketable securities. So marketable security is things that can be converted to cash very quickly. Like you are very sure that that thing can be converted to cash, not like it's 50-50. So an example is treasury bills, because for treasury bills, anytime you want your money, you can go for it at any time. So an example is treasury bills. So if you see treasury bills in the question, you add it to the marketable security. So that becomes your marketable security. And any other thing that can be converted to cash very quickly. But for the question or the values we have here, they didn't give us the marketable security. They didn't give us any value for treasury bills as well. So we can say it's 0 since we don't have it in the values. And the current liabilities is 50. So let's do it on the calculator. So we have 15 plus 0 over 50. And we have 0.3. So 0.3 times. So what this value means is that for the cash it has, or the money it has in cash, it can just pay its liabilities or its debts 0.3 times, which is actually not enough. Meaning if you don't, add the assets and other things, inventories or other things, it can't pay for the liabilities it has. That's what it means. So which is typically not so good for a company. So that's it for the cash ratio. So for now, we are done with the liquidity ratio. And we are going to move on to the activity ratio. And we are going to move on to activity ratio. An activity ratio measures how well the company is able to use its assets to generate sales. So how well the company is able to use its assets to generate sales. And the first one I'm going to look at is called the inventory turnover. The inventory turnover. So you can add ratio. So inventory turnover ratio. That's the first one. And this one measures how well the company is able to use its inventory to generate sales. How well the company is able to use its inventory to generate sales. And I said inventory are the things in a company that are yet to be sold but are not sold yet. So if it's, let's say, a company that is selling food or provisions, when you add the cost of the provisions, that's your inventory. But then they've not been bought yet. So how well you're able to use those things to generate sales, and how many times you're actually able to sell them, maybe in a day, a year, or a month, so that you turn them from its state, which is its normal state when it has not been bought, to actual money, to actual sales. And the formula for that one is cost of sales over inventory. And the cost of sales is what you see here, or less cost of sales is the same. Yes, so cost of sales is the same as less cost of sales over the inventory. Now in the question, they gave us the cost of sales, which was 120. So this is 120, then over inventory. And the inventory in the question is 50. So let's punch it on the calculator and see what we get. 120 over 50. We are getting 2.4. And this one is also times, so the unit is times. So we are getting 2.4 times. So let's say it's a year or a month. It means it has been able to transform its inventory to actual sales 2.4 times. So if it's, let's say, a day, so it has to be able to transform its inventory to actual sales 2.4 times. And if it's a month, it means in a month, it has been able to do that 2.4 times. If it's a year, 2.4 times. So that's for inventory turnover ratio. So you want to see if the company is actually selling its products, or the products are just lying there. Now we move on to the next one. Now we move on to total asset turnover. And total asset turnover is used to determine how well the company is using its assets to generate profit. So this one is talking strictly about the assets. And the assets are the things or the valuables in the company. And the formula for this is sales over total assets times 100%. So sales over total assets times 100%. Sales over total asset times 100%. And what is sales in the question? So sales is 200. So you can say 200 over total assets. And total assets is both the fixed asset and the current asset. And the fixed asset is 1,000. The current asset is 95. So in all, we have 1,095 for the total assets. then times 100%. And let's see what we get. You have 200 over 1095 times 100%. We are getting 18.264. So you can say 18.26. Yes. 18.26%. That's for our total asset turnover. So what this means is that 18.26% of the company's total assets is generated as profits. 18.26% of the company's total assets is generated as profit. And the higher total asset, if the value is higher, it means the company is using the assets very well or very efficiently. If it's also lower, it means the company is not making very good use of its total assets. And that's it about the total asset turnover. Let's move on to the next one. Now we move on to the fixed asset turnover. So unlike the other one where we're talking about all the assets, including the fixed assets and the current asset, this one we're only talking about the fixed assets. So how will the company is using its fixed asset to generate profit? And the fixed assets are the things that don't, or the things that the company actually has for a very long time. So the fixed things that it has, like the buildings, machines, and everything, those are the fixed assets. And the formula for that one is the sales over the fixed assets times 100%. Now, what is the sales? The sales is 200 from the values given. Then the fixed assets is 1000. Then times 100%. Now, 200 over 1000 times 100%. We are getting 20. 20%. So what this means is that the company is able to use 20% of its fixed assets to generate profit. 20% of its fixed assets to generate profit. So unlike the last one where we said the company is using that amount of money to generate profit from its total asset, this one is just on the fixed assets, not adding the current assets. This one is just the fixed assets. So now let's move on to the next one. Now we move on to the receivable collection period. Receivable collection period. And this is how long it takes the company to take money from people when they buy things on credits from the company. So if I go to a company and I want to buy something, but I don't have the money now, but I'm buying it on credits, this is what they are going to use to see how long it actually takes for them to give things out on credit, or the number of days or years or months it takes. And the formula for the receivable collection period is the receivables, which is the same as the debtors, over the sales times the period. And for the period, it depends. If you're calculating in days, it's going to be 365. If you're calculating in months, it's going to be 12. And for weeks, it's going to be 52. So if you're calculating in days, it's 365. If you're calculating in months, it's going to be 12. And weeks is going to be 52. And the reason is simple. There are 365 days in a year. There are also 12 months in a year and 52 weeks in a year. So if the question tells you to calculate the receivable collection period in days, it's going to be the receivable or the debtors over the sales times 365. That's if it's for days. If it says you should calculate it in months, it's going to be the same receivable or the debtors over the sales times 12, because there are 12 months in a year. So in months, it's going to be times 12. And if it's in weeks, it's going to be the receivable or the debtors over the sale times 52, because there are 52 weeks in a year. So when the question gives you the period, you should know how to do it. So that's basically it. Now, what's the receivables, which is the debtors? And that one is here. Oh, it's supposed to be 30, sorry. The debtors is actually supposed to be 30. So 50 plus 30 plus 15, giving 95. Sorry, I made a mistake. It's supposed to be 30. So we have 30 over sales, and the sales is 200. So guys, unfortunately the light just went out, but I hope you guys can see. So yes, the receivable or the debtors, which is 30, and the sales 200. Then if the question says you should calculate it in days, it's going to be times 365. So for this one, we are going to assume that the question asks us to calculate it in days. So now let's see what we get. So we get 30 over 200 times 365. And we have 54.75. So we can just say 55. We can just round it to 55. So we have 55 days. So what this means is that the receivable collection period for that company is 55 days, meaning that when someone buys something and they are given on credit, it takes up to 55 days maximum for them to pay. So that's about the receivable collection period. Now we're going to move to the next one, which is the payable collection period. Now we move on to payable collection period. Payable collection period. And payable collection period is how long it takes the company to pay its suppliers when it goes to borrow from them. For instance, if it's, let's say, a real estate company or a construction company and they need cement, so they go and take cement from a particular company, how long does it take for them to pay back when they've borrowed? That's basically it. So more like the liabilities. And the formula for the payable collection period is the payables. And the payables is the same as the current liabilities. So payables or the current liabilities. So you can just do a CL because of space over the sales. And for this one too, it's going to be times, if it's days, 365, if it's month, 12, and if it's week, 52. And if it's week 52. So yes, the same thing for this one. And like I said, the payables is the same as the current liabilities. And what's the current liabilities in the question? It says 50. So we have 50 over the sales, and the sales is 200. So we have 50 over 200. And the first one you calculated in days. So this one you can also do it in days. So times 365. Now let's see what you get. So we have 50 over 200 times 365. 91.25. So 91.25. So you can just make it 91 days. So what this means is that when a company goes and borrows from its suppliers, it takes them a maximum of 91 days for them to pay back or for them to pay their liabilities. Okay, so the light just came back. So as I was saying, what this means is that it takes 91 days for them to pay back their suppliers when they go and borrow for them, or for them to pay their liabilities. That's what it means. And as a good company, your receivable period should be shorter than your payable period so that there's enough cash flow in the company. What this means is that if someone comes to you on credit or someone buys something from the company on credit, the time they should take should be shorter than the time that it takes for you to pay, your suppliers or your liabilities. So that when they pay, you can actually use some of the money to even pay the people you are owing. You get it? So yes, we use the payable collection period and the receivable collection period to see if the company is actually doing well, to see if the receivable period is always shorter than the payable period. If the payable collection period is longer, then it means there's a problem. There's not going to be enough cash flow. So as a company, you're always supposed to make sure that your receivable collection period is always shorter than your payable collection period. Yes, that's it. Now we are done with the activity ratio. I'm going to move on to the gearing ratio. And for the gearing ratio, it's used to see the long-term stability of the company, or how well the company is doing in the long run, and how well it's able to pay its debt in the long run. So this one focuses on the long run, not the short run. And for the gearing ratio, the first one I'm going to look at is the total assets to equity ratio. So a total assets to equity ratio. And for by the name, you can tell what it is. So yes, so this one is used to see how much of the company's assets is financed by equity. And equity is the shareholders' wealth or the owner's wealth. So how much of the company's assets or the total assets is actually financed by the shareholders? So you want to see if it's actually financed by the shareholders or it's financed by maybe borrowing. You want to see the strength of the company. If they're actually surviving on maybe loans or something, or they are surviving on the company's actual money, which is the shareholders' money. And the formula for this one is the total assets over equity, which is the shareholders' wealth. So I can say SW for shareholders' wealth, then times 100%. And what is the total assets from the question? So the fixed asset is 1,000, the current asset is 95. So in total you have 1,095 over equity. And where is equity? So equity is 750 times 100%. Now let's punch it on the calculator and see what you get. So you have 1,095 over 750 times 100%. You are getting 146%. 146%. And the next one is long-term debt ratio. Long-term debt ratio. So for the first one, I wanted to see how much of the company's asset is funded or is financed by the shareholders' wealth, so that we'll see the company is actually strong. But for this, we are going to see how much of the company's asset is funded by loans or long-term loans. Because in the company, you are going to be taking loans to help support the business or to help finance the business. So we want to see how much is actually financed by the long-term loans. And the formula for that is the long-term debt or loans over the long-term, let's say, loans plus equity times 100%. So if you want to see if the company is surviving on the loans or the shareholders' wealth, you use this one. And the formula is long-term debt or the loans. So the long-term loans over the long-term loans plus equity times 100. And what is the long-term debt or the long-term loans? The value here is, yes, 270. Long-term loan, 270. So we have 270 over long-term loans again. 270 plus equity. And where is equity? Equity is 750 times 100%. And that gives us, so 270 over 270 plus 750 times 100%. We are getting 26.47%. So we have 26.47%. What this means is that 26.47% of the company's assets is funded by the long-term loans that they've taken. It means it's surviving on the loans that they've taken, the long-term ratio. As a company, you have to ensure that your long-term debt ratio is very low, because if it's very high, it can easily collapse, because at the end of the day, you're supposed to pay. And if you're not able to pay, the company would most likely collapse. So the higher the long-term debt ratio, the less successful the business is. And the lower it is, the more successful the business is. So that's basically it for the long-term debt ratio. So we're going to move on to the last one under the gearing ratio, and it's the interest cover ratio. So we've actually spoken about it. So it falls under both the profitability ratio and the gearing ratio, and we spoke about it already. So we said it is the profit before interest and tax over the interest, and that's it. So the profit before interest and tax is 40. Oh, sorry, 50. So it's actually 50 over the interest end, and the interest end is 10. So we have 5 times. So as we said, it's the same thing as the one we said. There's no difference. So it means the company can pay its loans or its interest that it's supposed to pay to the bank 5 times. That's basically it. So yes, that's the last one for it. And probably in the next video, or when we choose this topic again, we're actually going to do a video where we are going to solve only questions. We're going to look at any other thing that we've not covered in this video. Unfortunately, time is fast spent, but then yes, if you guys have any questions, please comment down in the comment section. And make sure you share this video with your friends. You like, subscribe, comment, and share. And that has been all for financial statements analysis. And I'll see you guys in the next video.